Subscribe to our channel and click on the bell button to receive important financial updates faster than anybody else.
Friends, welcome to another video on your channel Profit in Equities. If you like our content, please don't forget to hit the like button. Also subscribe to our channel, click on the bell button and choose all notifications to receive important financial updates from our channel at the earliest. In this video, we'll be talking about two fundamentally sound stocks which are attractive candidates for mergers and acquisitions. Now both of these are microfinance lenders which had converted to small finance banks and had faced the twin challenges of soaring delinquency in the aftermath of demonetization and higher operating expenses on account of conversion to a bank. The erstwhile highly profitable businesses reported losses in certain quarters of FY18. However, their performance in the first quarter of current fiscal is reassuring. The toxic book is now largely provided for and the worst of asset quality issues are behind them, although some lurking fears in the mind of investors cannot be wished away in a pre-election year. Please watch this video to know more about these stocks.
Now the first stock on the list is Jeevan Financial Services Limited, which is available at Rs 345.15 and the face value for it is 10. The symbol for it is UJJIVAN. Now Jeevan Financial Services Limited, formerly Jeevan Financial Services Private Limited, is a non-banking finance company engaged in the microfinance lending business. The company's products and services include microfinance, micro and small enterprise business finance, agriculture and animal husbandry finance, and housing finance. The one-year chart shows that this stock has been range-bound throughout the entire year. In Q1, assets under management has grown 21% year-on-year, whereas disbursements grew a respectable 23% for Jeevan. The momentum prior to demonetization is clearly visible and growth is much more broad-based. For Jeevan, the non-microfinance book is still a minuscule 10% but has been showing strong traction from a year-on-year and sequential perspective. Jeevan is de-risking its portfolio and is targeting 1/3 share of its portfolio from secured lending in the coming 3 years. The share of deposits in total borrowing, which was 6% for Jeevan in the year-ago quarter, has now increased to 49%. However, the deposit composition is skewed towards wholesale with the share of CASA at 6.3%. An improvement on this front would support future margin. Jeevan has seen stability in its net interest margin thanks to decline in the cost of borrowings to 8.6% at present from 9.8% in the year-ago quarter. Also, for Jeevan, credit cost had shot up 400 bps in FY18. With the toxic book of micro-lending post-demonetization largely provided or written off, credit cost normalization should propel earnings growth from FY19 onwards. The second and final stock on the list is Equities Holdings Limited, which is available at Rs 142.20 and the face value for it is 10. The symbol for it is EQUITAS. Now Equities Holdings Limited is the holding company and its segments include microfinance, other finance and others. The microfinance segment consists of microfinancing, whereas the other finance segment consists of housing finance and vehicle finance. The company also provides loan to subsidiaries and corporate guarantees for the borrowing of subsidiaries from banks and institutions. The one-year chart again shows that this company has been an underperformer throughout the year. Now, along with asset quality pressures, performance of microfinance stocks was impacted in the past because of conversion to small finance banks from their erstwhile status of microfinance lenders. Banking operations appear to be stabilizing and growth is making a comeback. In Q1, assets under management of Equities has grown 28%, whereas disbursements grew a strong 80%. For Equities, the year-on-year growth was mostly driven by non-microfinance portfolio, which has grown to 73% of the total. Operating expense rose due to rapid rollout of bank branches and muted interest earnings as a large part of the micro-lending book was not yielding returns. This resulted in a sharp hike in the cost-to-income ratio. The management of Equities feels bulk of the capex is behind it and effective sweating of assets and improved productivity would gradually bring down the cost-to-income ratio. For Equities, deposits that stood at 29% of total borrowings at FY17 end has now touched 49%. It has done reasonably well in garnering low-cost current and savings accounts (CASA) that now stands at 32% of deposits. Consequently, the cost of funds has fallen to 8% from 9.2% in the year-ago quarter. The fall in interest rates is much lower than the overall decline in yield on advances. Now, while Equities and Jeevan have rallied from their bottom, they still look inexpensive compared to the valuation they enjoyed prior to demonetization, albeit with the prospects of lower return ratios. With a pan-India presence and relatively high-yielding book, they remain attractive candidates for mergers and acquisitions by relatively larger entities. Seen in this context, the valuation has enough headroom to re-rate considering the deal valuation between Bharat Financial Inclusion and IndusInd Bank, which was at 3.8 times FY19 estimated book value. Investors should definitely look at these two small finance banks. Now friends, please don't consider this to be a recommendation on our part. Please go ahead and do your own research. This and all other content that you see on our channel is intended to be a piece of news. Thanks for watching, and if you have not yet subscribed to this channel, please consider doing so.